On January 1st, 2013, Sample purchased property composed of land, building, equipment, and furniture and fixtures. The total price of this basket, this is called a basket purchase, is $400,000 for the entire property. The vendor agreed to the following payment schedule. So they bought land, building, equipment, furniture and fixtures, all for $400,000, and the payment goes as follows. They issued 100,000 common shares at $2 per share. That's the market price. They also signed a 5-year 100,000 notes payable with a stated rate of 6% due 5 years from the date, but the market rate is 7%. So this is an example of a note issued at a discount. Okay, why is it a discount? Because they were issuing a note at 100,000 at the stated rate, which is the rate in which the note is paid, the interest paid is 6%, but the market rate is actually 7%. So we've got to take a look at using present value techniques to determine the fair value of this note. Then it says the balance of the price, purchase price of 100,000 is due 30 days from the date of purchase. So the date of purchase was January 1st. 2% discount is provided if the buyer pays the invoice within 10 days. Now, unfortunately, it says cash was deposited on January 12th, 2013, which is well above the 10-day period because they bought it on January 1st, and of course, they missed the discount. Now, our standards requires us to record the price, the purchase price of a capital asset, in this case, the property, at the lowest possible price, which means that we've got to incorporate net of discount in calculating the fair value of the price that we paid for the property. So we have to be able to deal with that discount's loss, and we're going to have to expense it in the income statement as the other videos have shown you. Now, in addition, Sample incurred the following expenditures. So here, what we've got to decide of all of these charges that we paid in addition to the $400,000, how much of this goes with the capital asset as an addition to the capital asset, and how much of it is expensed because it doesn't add future economic benefit. So let's look at the first one. The first one is $50,000 sales tax. Because sales tax is a refundable tax, it means that when Sample Company pays the tax, it's going to recover it from the government because they're not the final end consumer. So in this case, that $50,000 sales tax is going to be recorded as sales tax receivable or GST receivable or HST receivable because it's going to be recovered by the government. Okay? Because we're not the end consumer, because we're going to use the asset to help generate revenue, which we're going to charge tax on. Now, the $3,000 registration is only for the land and building, so we're going to have to allocate that $3,000 to the cost of the land and building. The $8,000 legal fees, because it's related to the entire purchase, we're going to have to add it to the $400,000 to allocate to the various purchased. The $2,000 regular, well, that one is just a cleaning to the building that was left by the seller. That's not going to add value to the building. We're just cleaning it up. So that $2,000 should be expensed. The $14,000 was an extraordinary repair to the equipment. The word extraordinary means that it was necessary to get to the intent for the equipment to be useful, and that extraordinary repair increased the useful life of by 3 years. So therefore, that should be capitalized only to the equipment. The $5,000 inspection fees are only for the equipment and furniture and fixtures, and again, that would have been important to get the asset to its intended use. So the key is that we've got a group of expenditures that we need to figure out how much of it should go to the balance sheet as part of the cost of the asset, how much of it should be expensed, and for those items that are recorded as part of the balance sheet, part of the cost of the asset, how do we split it between each of the components of the property? Now, we are given the appraisal value at the time of purchase, and we're going to use this to prorate the acquisition cost. So why don't we first start with the analyzing the consideration paid. So first of all, we paid common shares. So it starts with a CS, or short form for CS, common shares. We issued 100,000 times $2 per share. That's 200,000. Notes payable. Okay, so because of the fact that the notes payable is the stated rate is 6%, we're going to present value the principal times time value in money. We're going to multiply that by n equals 5. We're going to look for present value factor, and I equals 7%, which is the market rate. That should give us a present value factor of 0.7130. That gives us 71,300. Plus the interest is 100,000 times the stated rate of 6%. So it's 6,000 annual interest payment. And now we're going to multiply this by the present value of an annuity factor of n equals 5, I equals 7%. That should give us 4.1002 is 24,601.20. So the sum of all that is 95,901.20. So basically the note had a fair value of 100,000 because the market rate is higher than the stated rate. To make our note attractive, attractive to the seller, because that's part of our consideration, we had to discount, right? So that discounted value, the fair value of this note, is actually 95,901.20. And of course, we have an invoice for the remaining. And the remaining would have been 400,000 minus 200,000 common shares minus the 100,000 fair value of the note. So we know that this is 100,000. And remember, we got to record at the lowest possible price, which means that we're going to record at 98% to 98,000 to give us a total consideration of 393,901.20. Now, of all of these expenditures, we're going to take that legal fee related to the purchase because it's going to benefit the entire basket. That was the only cost that we've incurred that benefits the entire basket. So we're going to add the legal fees. To come up with the amount that we need to allocate to land, building, furniture, and fixtures. So how are we going to do that? First, let's take a look at the fair value. So we've got land, building, equipment, and furniture and fixture. And what we have is we have been given the appraised value The appraised value is 170, 227,500, 100,000, and 52,500. We're going to use the relative values. We're going to determine the percentage of the relative fair value. So we're going to take 170 divided by 550. So this is the appraised value in percentage. So this is 30.31%. This is 41.36%, 18.18%, and 9.55%. Altogether, this is 100%. All I've done is I want to take the relative values within the basket. So the basket consists of 4 things, and the fair value of each of these 4 things adds to 550. So I want to know what percentage of land is to the basket. It's 30.31 by taking the 170 divided by the 550 as an example. Now I'm going to take the total consideration, which is really this number here, and I'm going to prorate it based on these percentages. So 401, 901, 20 times 30.31 gives me 124. And this one is 166, 240, 95. This is 73, 072, 95. This is 38, 363, 30. So all I've done is taken the total, including the legal fees. Now I could have separated legal fees on its own, but I decided not to, because what I needed to do is I needed to look at those expenditures and figure out which of those expenditures are going to benefit the entire basket. And the only one that really benefits the entire basket is the legal fees, because you needed the legal fees to execute the deal. Now, if I look at the next one, it says registration for the land and building. Well, registration, that was $3,000. That only benefits the land and building. So I'm going to use the relative fair values only for the land and building. So we know that the appraised value for land and building, so let me just separate this out. So the appraised value is 170 and 227,500. So this is 397,500. So the percentage is going to be 42.7%, and this is 57.23%. So I'm going to use the relative values of the percentage only for the land and building, because the registration only related to the land and building. So in this case, it's 1283.02 and 1716.98. So this 3,000 gets allocated based on the relative values of land and building. Now, what about the 2,000 cleaning fees? That one we're going to expense. What about the extraordinary repair to the equipment? That one's going to be added only to the equipment, because it only benefits not the entire basket, but only for the equipment. And what about the inspection for the $5,000 inspection for the furniture and fixtures and equipment? The same idea. So now I'm going to put down here for equipment, so the appraised value, so it starts with the AV, short form AV, and I got equipment and furniture and fixtures. The appraised value is 100,000 and 52,500. That gives me 152,500. The percentage of the appraised value is 65.57%, 34.43% is 100%. So we're going to take the 5,000 inspection. We're going to take the 5,000 and split it, right? 5,000 times 65 is 327,869. And this is 1,721,31. Okay, so that should add up to 5,000. So here's the bottom line, because the first part asks us to do a journal entry. So what I'm going to do is I'm going to summarize this chart along with this chart down here. So we've got equipment. So we've got land. Let's start with land. We got building, equipment, furniture, and fixtures. So we know that the total consideration we know this is 124,224. Building is 166,240. 73,072.95. And 38,363. 38,363.30. This should add to 401,901.20. Then we had registration. Registration, we know that it only was for land and building. Then we're told that we've got extraordinary repairs for the equipment. Extraordinary repair was only for the equipment, so we're going to add that to the equipment. That was for 14,000. Then we had inspection, right? Inspection was only for the equipment and furniture and fixtures. Okay, so if we add them up, we get 125, 507, 03. Building, what should be 167, 957, 93. Equipment should be 73,000 plus 14 plus 3. That should give us 90,000. 351, 63. And furniture and fixture should be 38 plus 1,000 is 40,000. 084.61. The total should be 423,901.20. Now, the 2,000 we know we need to expense, and the 50,000 is actually the income tax, right? So why don't we do the journal entry? So first, let me credit the common shares, right? So what do I do? Why don't I debit land first? 125, 507.03. On a debit building, 167, 957.93. Equipment is 90,351.63. Furniture and fixture is going to be 40,084.61. Now remember, we had to clean, right? Cleaning fees is an expense. 2,000 because we had to clean it. And remember, we had sales tax receivable, right? Because remember, there was a sales tax that was paid, and because sales tax paid on equipment is a recoverable tax, let's assume it's HST, we recover that because we're not the end consumer. Although we use the equipment or the property, we use it to generate revenue, and we're not the final consumer. So that's why we don't pay the tax. Okay? That's sales tax. Now, remember we had a discount, didn't we? So when we first calculated this, we incorporated only 98%. The 2,000 is a discounts loss, which we're going to expense. So discounts loss is the 2,000, which is the 2% times the 100,000. So these are my debits. Now what are my credits? So these are my debits. It's a big entry. My credit's going to be, first I'm going to credit common shares. We know that that was 200,000. We did calculate that, didn't we? Then we had a notes payable, and we discounted that notes payable to 95,901.20. Now we're going to credit cash. We know that we paid 100,000 for the invoice plus the sales tax, so let's call it HST, plus, if you look back at the question, we had a registration of 3,000 plus the legal fees of 8 plus the 2,000 cleaning fees plus the 14,000 extraordinary repairs plus the 5,000 inspection cost. That should give us 182,000. So if you balance this, the total debit and the total credit should balance. And that is your general journal entry. Now, looking at part 2 of the question. So we did make the journal entry. We did that. So we've analyzed the acquisition. So this is an example of a basket purchase. So there's a couple of learning objectives here. The first learning objective is the fact that we need to analyze the consideration paid. In this case, the consideration paid included 2 important learning objectives. The first one is the fact that the note that was issued to the seller had to be discounted. Why? Because the note only pays 6% interest, but the market pays actually is 7%. So we have to fair value the note to determine the price that we paid. So obviously we paid less because the market is higher than what we're paying. So that's where we had to discount the note. The second learning objective under the consideration paid is the fact that we missed the discount. The discount was only, 2% was only if we paid in 10 days. We didn't. So we have what we call a discounts loss, and that has to be recorded as an expense. So you have to pay 100,000 for the supplier's invoice, but you have to record the equipment at net of discount because it should reflect the lowest possible price of that equipment. So that's the first part of the learning objective. The second part is the fact that we have a basket purchase. we paid $400,000, we have to split it between what the component of each basket. Now, why do we do that? So under GAAP, we have to record each component of the property under each separate category. It's required. And furthermore, you'll see that land is something that we don't amortize or depreciate, but building we do, equipment we do, and furniture, fixtures we do, and the amortization may be different for each one of these types of assets. So that's the reason why we have to split the basket purchase. The second learning objective under the what did we buy is we have a whole bunch of these expenditures, and we have to decide how much of these expenditures, or which of these expenditures are going to benefit the basket. It should be capitalized as an asset, which ones should be expensed. So we know that cleaning, regular cleaning fees should be expensed because it doesn't add to the value of the building. The extraordinary repairs, the word extraordinary means it is more than the normal repairs of the equipment, the normal general repairs and maintenance of the equipment. That has to be capitalized to the cost of the equipment. And given the fact that it did increase the useful life, means that we need to capitalize that to the equipment. And of course, you'll see that we had to analyze it, how much of these belong to which component of the basket. Now, the second part of the question takes us through the amortization. It says the building has a useful life of 20 years, residual value 30, and we're asked to record the amortization expense for 2014, using double declining balance method. So we're going to calculate that. So for the building, so let's look at part 2 of the question. The amortization is double declining balance method. So to calculate the rate, we need 1 over straight line times 2. And the straight line is, we're told that the building has a useful life of 20 years. Means that we're going to amortize it 10%. Okay, so for the building, our net book value of the building at the time 0, we know that the building was $167,957.93. So for 2013, remember we bought it on January 1st, so we have a 12-month period. The depreciation expense is $167,957.93 times 10%. Gives us $16,795.79. The cumulative is the same. Net book value will be less. For 2014, we're going to multiply 151,162.14 times 10%. The accum will be the sum of these two. And net book value will be less, right? So 151,162 minus 15,000 is 136,045.92. 2015, same calculation. We're going to take 136,045.92 times 10%. So 13,604.59. Add it to the 31,912. You get 45,516.60. And of course, take this number from the 167. Okay, you should get 122. Or take 136,045 minus the current year's depreciation to give you the 122. So there's two different ways to calculate the net book value. 2016, we've got 122. So keep on doing this until you get to, obviously, until you reach the residual value of 30. Now, number 3 says furniture and fixtures have 5 years, no residual value. What is the amortization for 2013, assuming they use straight line for that asset? So again, let's take a look at what the furniture and fixtures amortization would be. So furniture and fixture is 5 years, straight line, residual value 0. So the calculation is the depreciation rate is, we're going to take the furniture and fixture, which is 40,000, 0.84, 61 divided by 5 years. There's no residual value. It's 8016.922 per year. And you'll see that the depreciation expense, because there's no proration, right? It's going to be the same each year. Okay. And the cumulative depreciation net book value will obviously be different, right? 801692. This will be 16033. And net book value, this will be 32. So we know at the end of 5 years, the net book value should be 0 because there was no residual value. Now, the next part of the question, it says, the equipment has expected to last for 7 years with 3,000 residual value. The management expects to incur a minor restoration cost of $500 to restore the building at the end of its useful life. What is the amortization expense, assuming the company uses straight line? So this one here, we're dealing with the equipment, right? Okay, so the equipment it's 7 years, straight line. The residual value is 3,000, and there's a minor restoration of 500. So the amortization should be, so the depreciation rate should be, okay, so we're going to take the cost of the equipment, in that case, is $90,351.63. We're going to subtract the residual value of $3,000. Now, because there's a minor restoration, we're going to net the $500. Because it's considered minor, we're going to adjust the residual value. If it was a major restoration, so let's say we have to spend a lot of money restoring, the environment, or is it the property, then we would have to record it as an accrued liability at the date of acquisition. But this one here is a minor restoration. We're going to net it against a residual divided by 7 years. So the amortization is $12,550.286 per year. So now I'm going to record the amortization. So we know that with straight line, 2013 for 7 years. So let's write down the 7 years. 14, 15, 16, 17, 18, and 19. Because we bought it on January 1st, there's no proration. So this is depreciation expense. We know what that is 112,550.23. That's the same each year. Now, the accum would be the sum of all of these amortization, right? And the net book value, first of all, we had $90,351.63. Take away the $12,550 to give us a net book value of $77,801. Again, $77,801 subtract $12,550, you should get $65,251.17. And you notice the net book value at the end of its useful life is $2,500, which is essentially the residual value less the minor restoration cost. Now, the question says, under GAAP, would Sample be able to use the double declining balance for building and straight line for furniture and fixtures? In other words, what they're asking us is it possible to use different amortization method for different groups of assets? In this case, it would make sense to use different amortization for different groups of assets, or different useful life for different groups of assets, as long as it properly matches the usefulness of the asset over the life. So if you think that the building, it has a different benefit, different usefulness over the course of using the building, as opposed to the equipment. Perhaps the equipment may be best if we use straight line or double declining or units of production. GAAP allows companies to use different methodology as long as it makes sense, as long as it properly reflects the benefit or the usefulness of that asset over its economic life. Thank you.